Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome back to the show, Bob.
Yeah, Jim, good to be with you. I guess the big buzz this week is Trump's 100 days in office.
The latest figures showing, Bob, that in the first quarter in the U.S., lowest economic growth in 3 years. Canada, though, in February, no screaming hell either. We had zero growth. Why have things slowed down so much, either under Trump or under Trudeau?
Yeah, well, Trump or Trudeau have little to do with it other than increasing the burden of taxpayers and the economy, or decreasing the burden. The idea that the state is a beneficial organ should be pushed out of any conversation. The economy, business activity is flattening, and you have some incredible distortions going on. It's been those ambitious people in government who are deluded into thinking that they can manage the economy, so they keep coming in with red tape and rules and regulations that is choking up business activities. So then you have another set of economists who take a look and say, oh, the economy's too weak, we'll get a recession, so therefore we'll put on all kinds of monetary stimulus, QE1, QE2, and we'll buy bonds out of the market, and that'll stimulate the economy. But it doesn't work. So what you have here is the economy knows how much credit it needs. And there's been periods in time in history when the senior economy, England, did not have an aggressive central bank. It had a central bank, but the central bank was attending to the value of the currency and the reserve behind it. And the economy did just fine through the 1900s, right through the 1800s, and grew tremendously, and you had the business cycle and all that sort of stuff. But so you can take apart the argument of intrusion, and that is, first of all, they assume that there is a national economy. Now try and tell me that Canada's economy is distinct and separate from that of the U.S. with a common border 4,000 miles long. There's not even a thing as a national economy in Canada. So then there is no such thing as a discrete national economy. So one of their foundations gone, just like that. Then the other one is that they've noticed that on a business expansion, activity goes up and business borrows some money, and so credit expands. But they've done the stupid thing of assuming that then credit pushes business. So then that's where this has been going on for, well, we used the Federal Reserve for 100 years now. And that is not the case. That is, in logic, it's called a primitive syllogism, that because the roosters crow in the morning, that causes the sun to rise. And that's what these bigwigs at the central banks are doing. They saw that business expands and credit expands with it, so they figure if they push credit, that will then result in business activity. But it's not the case. What happens is when they push credit, it'll go somewhere. That it goes to where the public wishes to speculate on. So if we go back a long time ago to the 1970s, and they were very aggressive in expanding credit. And what happened? Well, it went into speculation in wholesale prices, retail prices, and wages, and it drove this. And that's really the foundation of the Consumer Price Index. So it drove the CPI up to 15% in the U.S. in 1980, 81, and long-dated treasuries got up to 15%. In Canada, they got to 19%, because the public chose to speculate in commodities and wages and property values and stuff like that. And then the whole world changed in 1981, 82, where the aggressive credit expansion by the central bank continued, but commodities crashed, CPI came down, and the next game became inflation in financial assets. And this, of course, has been played ever since. So what has happened here is that the economists still think there is such a thing as a national economy. They still think that artificial expansion of credit will prompt business activity. No, it's all gone. This time it's all flying off into residential housing speculation, very intense in Canada, particularly Vancouver and Toronto, and becoming very intense in the United States. And really, what policymaker wants to have a reckless speculative surge in house prices? No, they don't. But it's a consequence of their reckless and careless policies. So, anyways, how do you get out of a bubble in house prices? Well, it crashes. Eventually it will. And then the other one was that you had a very huge and speculative bubble in lower grade bonds. And we should back up a year to in June, July, when the hot action in bonds was in long-dated treasuries and long-dated Canadas, and got up and registered all kinds of technical excesses, such that we then called it ending action. And the decline in long-dated treasuries was one of the worst in decades. But at the time, in July, we figured that where the long-dated treasury can go down in price, we thought that the action in low-grade bonds, junk or high yield, would continue, which it has done until the last 3 or 4 weeks, where, guess what? We're getting technical excesses. And so what these easy money policies have done have allowed people to become reckless in their own accounts. And you've seen here in Canada with this lending company that blew up, and they had been doing mortgages and loans and commercial loans and home loans and all kinds of things. And they ran out of money because they were reaching for deposits. And I saw the chart there that from the end of March, all of a sudden, whoosh, their deposits left. So it was like an old-fashioned bank run. But now they come in and bail it out with $1 billion or so. But what agency bails it out? Some pension fund in Ontario that's made up of 325,000 people, none of whom are probably sophisticated in the financial markets, but the management of that pension fund decided to be heroic. And so this is not going to end well. And you can say, well, it's a modest-sized thing in Canada and won't affect the United States. But I can remember back in 1965 when the Canadian company Atlantic Acceptance, again, it was lending to households, and it ran out of deposits and blew up, and it shook the markets in U.S. for a while as well. So, but the main thing is it's one problem within a sea of problems. So, and that it was supposedly rescued by a pension fund is that's bad stuff.
We're talking about home capital, aren't we?
Yeah, home capital. It's not.
And I just saw there was a $200 million run in the past week on them.
Oh yeah, and this pension fund, you have the principles of it, the fiduciary responsibilities to the pensioners. They have no responsibility to go out and save a lending agency that went reckless and is crashing. This is it's a horror show. It's a travesty of fiduciary responsibility, and there'll probably be more of them. So it's an example of expertise that doesn't exist, and it has too much power and too much authority and very little, obviously, by the way of checks and balances. So, and it's everywhere in the States, in Canada, in Europe, in England, a whole bunch of reckless policy making going on at higher levels. So, and it can't end well. So anyways, we should look at the opportunities in the market here.
And we'll do that, Bob, right after the break.
Very good.
I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario. With grab samples running as high as 32 grams per ton gold, a drill program will commence this spring to test the numerous targets located by recent groundwork. For more information, visit our website, rmroyalty.com.
Aven Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Aven's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avenresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, what kind of opportunities have these differences and changes made?
Yeah, well, what we have here is a narrowing of credit spreads that began in February 2016. That was when crude oil crashed, and it took junk bonds with it and high yield, and it was looking back on it, it was a magnificent crash, became oversold, and then has recovered ever since until about 4 weeks ago when let's call it the technicals are beginning to change. So we're looking for a change in the party that's been on in lower grade bonds. And when is it going to change? Well, we look back, and often in history, if you have a very enthused junk bond market and spread market going into May, you can get a seasonal change there, and then you can remember the old saying that sell in May and go away. I mean, and you can look at the stock market itself and you can't really find anything that links. But when you look at the credit market and realize that there's a seasonal tendency in here for a change, you become quite wary, and especially when you've got technical excesses on the move, which we have now. So this bond bubble has been the biggest in history, and it's due to ignorance at the policy levels, where they push out credit thinking they'll get GDP growth, and which we're seeing here in Canada and the U.S., zip growth. And then where'd the money go? Well, it went on to speculation in junk bonds and house prices. And to a degree there was some firming of industrial commodity prices up until March, and crude oil made it to $55 and backed off, and then the next rally we were looking for could make it to 53, and I think it got to 53.75. And then if it got below 50, it was below a certain moving average, and we're down to 49. So crude oil is rolling over. And it was, if you go back to 2015, in June is when crude oil rolled over, and the junk bond prices headed south and spreads widened. So we're set up for a repeat of that experience. And it's going to be quite exciting, and one should be avoiding lower grade bonds as best you can. Best to get into higher quality stuff where you've got liquidity. 3 to 4 year term on U.S. Treasuries. If for Canadians, buying U.S. Treasuries is ideal in here now because you'll get another run with a rising U.S. dollar. And then that, of course, we get that. We've got what's going to happen with with the precious metals, crude oil, and they link in often with crude oil. But gold and silver, you've had some modest rallies this year, but of the last 3 or 4 weeks, you've had silver declining relative to gold. And if one does the history of the gold-silver ratio, you'll know that when the gold-silver ratio goes down, it's party time out there. And it's got down to 76, and it's been rising up to 71 earlier in the week. And that was a signal that perhaps we got a trend change on here, and we should look at it. And indeed, it's now up to 73. So it broke above the last resistance at 72. So we're now saying that the gold-silver ratio is in an uptrend. And when it's in an uptrend, there could be a financial storm ahead of us. And that makes sense because we've been in a financial that has been absolutely incredible. So this is when you get a movement like this in precious metals, you realize that what you have with the gold-silver ratio is a metallic credit spread, and it's confirming what's going on, say, in the difference between high yield and long-dated treasuries. So there's change going on there as well that one should be aware of. We haven't been excited about the gold market too much because one of the features of a post-bubble contraction is generally weak commodity prices and a generally firm dollar. And I think this brings us to the question.
And we'll take a look at a listener's questions right after this.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Bob Hoye. Bob, we have some questions from Henry Solomon in El Paso. Did the rally this week in U.S. stocks represent the commercial firms selling off to the speculative small investors near the top of an overbought level?
Yeah, good question, Henry, but I don't know what the hell the commercial firms are doing, so I can't answer the question. All I know is that the stock market is became measurably overbought.
Henry also wants to know, is there any sign of the U.S. dollar being oversold?
Yeah, it's been declining, but basically we've been looking for the U.S. dollar index, the DX, to base through here for, a couple of months, which it has been doing. And it would also base with the 20-week exponential moving average, and it's been trading either side of that. And a week ago it started to come down quite smartly, but it came down enough and in a manner that it gave a springboard buy this week. So it is set up for a rally. Now what it has to do, two things: get above the 20-week EMA, which would be constructive, and then breaking above the last high, which I think was let's call it 101.5, getting above that then would really turn the trend up, and I'm thinking that a firming dollar would be very unwelcome. As a matter of fact, a couple of weeks ago, Fisher at the Fed said that if the dollar firmed up, they would be able to treat with it. So they don't want a firming dollar at all. So in which case, I think the market, when it starts to firm, it'll overwhelm them. So, and then the third question.
And Henry wants to know, do U.S. junk bonds appear overbought at this point?
Yes, they have. HYG has made a very high RSI figure and is overbought, and that also goes by implication into the credit spreads as well, which is the difference between lower grade securities and high grade securities. And often you can get a seasonal reversal in these. If it's party time in lower grade stuff going into May, there's a probability you'll get a seasonal change, and that then suggests there's a probability that you could have quite a bit of problem developing in the spread markets later on in the year.
Bob, thank you so much for chatting with us and for answering those listener questions.
Yeah, Jim, good to be with you, and look forward to next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. If you have any questions for Bob or for the show, you can email us at info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.